Hello dear viewers, welcome to this session. In this video we will see internal rate of return. Like as net present value, internal rate of return, which is IRR, is very important tool for investment decision in capital budgeting. So what is internal rate of return? In short, you can understand uh, or you can take internal rate of return as the point at which net present value is equal to 0. We have seen how to calculate net present value. Net present value is, in short, the difference between discounted cash flows or the sum of present values and the initial investment. So with internal rate of return, we look for the point at which this net present value is equal to 0, at which point we get net present value which is 0. That's the point that we are looking to calculate. So you see here, it is a point at which the sum of discounted cash flows, the one we calculate here, is equal to the initial investment. So at which rate these two, the initial investment and the sum of discounted cash flows, is equal. So we look for the rate. That's called internal rate of return. And it is used to estimate profitability of a business venture, and it simply helps to determine the break-even cash flow level of investment. And we get with internal rate of return, we get result is in the form of percentage. Whereas with net present value, we get dollar value, as we have calculated in our previous example. Great. So the problem with internal rate of return is that it does not provide us information about the money a project will likely generate in each year. But with present value method, we get the money that's going to be generated each year, discounted cash flow. We get discounted cash flow, and we know how much we make in dollar value. So that's the difference between the net present value and the internal rate of return. Let's calculate internal rate of return. As I said, with internal rate of return, we'll calculate the rate, not the dollar value. The rate at which the net present value is equal to 0. Excel has its own inbuilt formula. We simply look for that formula, equal sign, IRR, here you have, and then values. We put all the values in the bracket. We put all the values in the bracket, and then we close the bracket, enter. So this is the internal rate of return. This is very important point for us to make investment decision like as any PB. So as you see here, the internal rate of return 5% is less than 10% of the initial cost of capital. So coming to decision, if IRR is less than the initial cost of capital, the one we use for NPV, and then we should not invest. Do not invest. And if IRR, or the initial internal rate of return, is greater than the initial cost of capital or interest, we go for investment or invest. So in this case, our internal rate of return is 5%, while our initial cost of capital is 10%. So which one is greater here? Is the initial cost of capital is greater. That means the internal rate of return is less than the initial cost of capital. So we go for this decision. So do not go for this investment. I will elaborate this thing a little more. If we go for a cost of capital more than 5%, the cash we are going to generate will not cover the initial cost. At 5%, we totally or we fully cover our initial cost. I'll show you this. Let's calculate present value based on the interest rate we have here, which is the internal rate of return, 5%. And we see that at this 5%, the total money or cash which is going to be generated in 5 years is equal to the initial investment. So future value here for first year over in the bracket 1 plus interest rate, use this 5% and fix the sale reference, and then elevate to the degree of time, use this symbol, and then time you have here, enter. So if we drag this one to the right to all the years here, you see the sum is 500. You see the sum is 500. In this case, the sum is 500. So it's 500, 500. So at 5%, we fully cover our initial cost. If we go for a cost of capital or an interest rate more than 5%, the money we are going to generate will not cover the initial cost of capital. How? Let's see this with 6%. Let's see this with 6%, or let's go for 7%. So if the interest rate or the cost of capital we incur is 7%, can we cover our initial cost with the discounted cash flow or with the present values of the 5 years? Let's see this again, equal the present value, which is 30 over 1 plus the interest rate, which is 7 here, and then elevate to the degree of 1, and then don't forget to fix this cell reference so that it should not move, and then click OK. And then let's calculate the present values for all 5 years, and then let's see if we can cover our initial cost with 7%. We cannot cover because the discounted cash flows, the sum of discounted cash flows for 5 years with 7% cost of capital or interest will be 473.22. That means it will not cover our initial cost. So we should not go for cost of capital more than 5%. More than 5%. That's why we see here, if we go for this 10% cost of capital or 10% interest rate, we see its value here, which cannot cover uh, the total initial cost. We see here, which is less than 500. So that's how we make a decision. That's how I make a decision. If internal rate of return is greater than the interest rate we have here, then we go for investment. Otherwise, we don't go for investment. I hope you have learned something from this example. If you have any question, you can ask me on the comment section. See you with more videos. Thank you for your time. Bye bye.